Hi, I'm Professor Bei Dong from USF School of Accountancy. In this video, we're going to talk about the classification in the balance sheet. There are three elements in a typical balance sheet: assets, liabilities, and shareholders' equity, or you can call it owner's equity. Assets represent future economic benefits obtained by this company as a result of past transactions or events. So when we talk about assets, we focus on whether they can generate future economic benefits for us, and at the same time, whether this asset is generated from the past transactional events. So assets is something that you have right now and will create future economic benefits for you. Liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So liabilities will focus on this is your obligations right now, and it is resulted from past transactions or events. And in the future, to fulfill this obligation, you have to transfer assets, for example, pay cash or provide services to reduce these liabilities. Shareholders' equity are the residual interest in the asset of owner's equity that remains after deducting its liability. First of all, let's talk about assets. All the assets items are listed in order of liquidity. Liquidity means that how quickly this item can be converted into cash. So we're going to first classify assets into current section versus non-current sections. And the current sections are going to be listed ahead of non-current assets. Current assets are those cash and other asset company expect to convert into cash to sell or consume either in 1 year or one operating cycle, whichever is longer. Other assets are going to be listed in the section of non-current assets. We're going to talk about the current asset first. In the current asset section, first of all, we're going to list the cash and cash equivalents. Those are the most liquid asset. Cash, very easy to understand. Those are the money on demand. Cash equivalents are those short-term, highly liquid investments that mature within 3 months or less. For example, treasury bills. Then, after cash and cash equivalents, we're going to list short-term investment. It includes held to maturity, trading, and available for sale securities. Those are very short-term investments in which manager's intention is to get a capital gain within 1 year or one operating cycle. If manager's intention is to hold the securities more than 1 year or more than one operating cycle, then those investments will be classified as non-current asset or as long-term investments. Next, we're going to list accounts receivable. Accounts receivables are the monies your customers owe you after they purchase services and or goods from you. Inventories are the items or products for sale. Prepaid expenses are the payments of cash from you to your vendor. It is called expenses, however, it is an asset. It is recorded as an asset because services or benefit will be received in the future, and this is consistent with our asset definition. So those 5 types of current asset will be listed in this order. Cash and cash equivalents first, followed by short-term investments, followed by accounts receivable, followed by inventory, and then finally prepaid expenses. Then, non-current assets. Non-current asset includes long-term investments, PPE, and intangible assets. Long-term investments will include your investment in securities, tangible fixed assets, special funds, and non-consolidated subsidiaries or affiliated companies. Securities means that you invest in other companies' bonds or other companies' common stock, or you just lend some money to another company and get this long-term notes. Tangible fixed asset particularly refer to those fixed assets not currently used in the operation. For example, you have a piece of land held for speculation, not held for the daily operation. Special funds includes sinking funds, pension funds, planned expansion funds, or cash surrender value of the life insurance. Non-consolidated subsidiaries or affiliated companies, those really means that your ownership in another company However, your ownership is less than or equal to 50%. So those are the long-term investments. The second category of this non-current asset is property, plant, and equipment. Those are the assets acquired for use in the day-to-day operations of the business. For example, you need to have a piece of land to, have your headquarters on it. For example, includes your buildings, headquarter buildings, or operational buildings. For example, you need to have a production line to produce your products. Those are the equipments. So those will be included in the property, plant, and equipment. The last category in this non-current asset is this intangible asset. Those are the asset, the lack of physical substance. However, those are assets generated from physical, tangible transaction, economic transactions. So these are non-current assets. After the assets, now let's talk about liabilities. Very similar to assets, liabilities are also listed in order of liquidity. So we're going to have two sections in the liability section, current liability and long-term liabilities. Current liabilities are going to be listed ahead of long-term liabilities. So what are those current liabilities? Current liabilities are those obligations that a company reasonably expects to liquidate either through the use of current assets or the creation of other current liabilities, which means that companies are going to use current asset to pay for it, or they're going to borrow new short-term debt to pay off this old short-term debt. Long-term liabilities are those obligations expected to require payments over a period of time beyond the current year. So those are the long-term liabilities, for example, long-term bonds. In the current liability sections, we have accounts payable, wages payable, interest payable, short-term notes payable, all these payables. Those are the payables that are representing obligations to a company's suppliers, employees, and creditors. And also in the current liability section, we have this deferred revenue. Deferred revenue is called revenue, but they are not revenue. They're not going to be listed on the income statement. They're part of your current liabilities. The reason it is current liabilities is because this is the money you receive from the customers before you deliver the goods and or services. Since you get the money right now, and you have not delivered the goods and or services yet, revenue recognition principle says that you have not earned it. Revenue cannot be recognized. Instead, you're going to recognize as a liability because you have this obligation to deliver the goods and or services in the future. So they are liabilities. And then let's talk about long-term liabilities. Long-term liabilities include long-term debt, pension liabilities, and contingent liabilities. Long-term debt includes your issuance of long-term bonds, your issuance of long-term notes for the purpose of getting all these long-term financing from the public market or from some specific personal companies. Pension liabilities are the obligations the company has for their employees after they retire. Contingent liabilities are those liabilities depends on the future events. For example, you sell something to the customers and this product comes naturally with a 1 year manufacturing warranty. So which means that within this 1 year, if there's anything wrong with this product, this customer can bring it back and ask you for either the exchange or ask you to fix for them. So managers are obligated to estimate the possibility of this customer is going to bring back those products within this 1 year warranty period. Okay, so that is part of your contingent liability. Last section of balance sheet is owner's equity. As we just talked about in the first or second slides, owner's equity is the residual interest left over after creditors have received their dues. So it is also called a net asset, equals your assets minus liability. It actually includes two parts, contributed capital and the retained earning. Contributed capital is the direct contribution from shareholders to the company. It consists of capital stock and additional paid-in capital. Capital stock is an account that recognizes the par value of the shares issued, while additional paid-in is the premium or the excess of the amounts paid by the shareholders over the par value. For example, let's say a typical par value of a Google stock is $100. When Google sells the stock to the market, Okay, let's say the stock price is $200. So after Google received this $200 money from their shareholder, they're going to record $100, their par value, in this capital stock account, while the other $100 will be recorded in this additional paid-in capital account. So this is contributed capital. Next part is the retained earning. Retained earning is the undistributed earnings generated from the inside of the company, from the internal operation of the company. So owner's equity, this section consists of two parts, contributed capital and the retained earnings. One is from the contribution of the shareholders, one is from the inner operations of this company.